Good evening from Money Matters TV. I'm Paul Sloate, CEO of Green Drake Partners, and with me tonight is Patricia Dunn, Senior VP, Wealth Management of Merrill Lynch. Good evening, Patricia.
Thanks. Glad to be here.
Well, so the market's been going up this year, and just for our viewers, I want to remind them that this show is broadcast on a delay to taping, so we advise that they consult with both their financial advisors and accountants before they act on anything we might say on the show. So let's get back to the market. The market's been going up this year so far. Give us some of the positives and negatives you see out there for the market.
Actually, the positives are that both revenue and earnings per share has been going up. The economy has been very good to businesses, and we're seeing the results. The negative, though, is that taxes have been a huge problem, and it is actually leading companies to leave the United States to become overseas companies. We have the highest corporate tax rate in all the industrial countries, and we are the only industrial country that double taxes profits made overseas. And this is driving some of our big corporations out of the country, and I just don't see that as being positive long term for us as a country.
Well, I agree that would not be a positive if all these large companies up and left the United States to go exist somewhere else in the world.
Exactly. So on that vein, what do you see in as far as what's happening in Europe these days?
Well, Europe appears to finally be getting its financial act together. The European Central Bank, which eased last year, is actually talking about putting in place additional stimulus measures. I mean, if we look at where Europe is compared to the U.S., their economy has barely recovered. And they've had a lot of problems because part of the problem has been the ECB has not put enough money into the system. And unlike the Japanese Central Bank or the U.S. Central Bank or even the UK Central Bank, which all entered into some type of quantitative easing, they have refused to do that so far. And in fact, part of their emergency measures have been pulled back from the marketplace. But at this point, they're finally seeing that they need to take more action so that their economy can grow, just like Japan's economy has started to grow and the U.S. has been growing over the last few years. So what's happening is they're now talking about putting in place significant stimulus in addition to what they've done. So for Europe, this would be a welcome change and really accelerate the growth. And part of the way to solve some of their problems, especially with sovereign debt, is for the European economy to grow.
I agree. I absolutely agree. Now let's go a little farther east. How about China? What do you see there?
Well, I think China has a bunch of very interesting economic issues. They've been massively overinvesting in their economy. And in fact, the investment has gotten so large that they are going to invest this year 3 times as much as the United States will invest for an economy that's only 2/3 the size of the United States. So they are massively investing in their economy. In fact, they're investing too much. And part of the reason economic growth has been slowing down in China is that this massive overinvestment is beginning to come under pressure and starting to slow down. And so that growth is just going to naturally slow because they can't absorb the goods in their economy, and they can't sell the goods outside their economy elsewhere. So that investment is going to have to slow in and of itself. And in addition, what's happened, because they've made this massive investment, their companies have come under a lot of pressure on the profit line because they've overinvested. And so they have too much goods, which has driven profits down. So what they've done to continue to fund the investment is they went out and borrowed money from banks. And when the banks that were established by the government wouldn't give them money, they went out and borrowed it from what they called shadow banking companies. And those companies might charge you 25% in interest or more a year. So what's happened is you've got this huge leverage in China to invest in a lot of areas where the profits of the companies really don't support the debt. So in addition to having an investment problem, they now have a debt problem. So this is a complicated issue. and the government is trying to work out how to slow the investment, preserve the banking system, and maintain economic growth at the same time. And so you will see as a transition from an investment-led economy to one that has more consumption than it currently does. But I think what you're going to see is the transition won't be smooth over time. There'll be bumps along the way, but they will do this transition. But you also see lower economic growth.
I agree. I agree.
And anyway, it's very interesting. The question from the viewer this week is from Mark Todd out of Marion, and it is about China. And he asks, do you think that China will continue to buy coal from the U.S. since it has such a pollution problem?
That's a very interesting question, and I'm going to take it in two parts. First of all, China doesn't import coal from the United States. China has quite a bit of its own coal, and of course Mongolia is rich in coal as well. And that's thermal coal, and that's the coal you use to generate electricity. And yes, as their economy exploded, the need for electricity expanded greatly. In fact, it was 3 times from like 1990 to the year 2000. It just exploded. And as a result, we created all this pollution, all this smog, all these problems. And then there's a second need for coal, and that is imported. And that's metallurgical coal. And they get most of their imported coal from Australia for steel making. Now, interestingly enough, Morningstar feels that this appetite for coal will peak here in 2014. And then it will start to decline till about 2020 as they start to shift towards alternatives. Cheap coal has driven their economy. As you said, we now have economic and political issues why this has to slow down. And add on top of that, environmental issues. The economy is going to slow down. They've got to find other sources of energy. This coal problem, I think, is going to solve itself.
Well, that's very interesting. If you would like to have a question asked on the show, please write us at Money Matters TV, 205 East Levering Mill Road, Ballackinwood, PA 19004, or email us at moneymatterstv@gmail.com. And now it's time for our guest tonight. Our guest tonight is Chuck Steege. He is president of SFG Wealth Planning Services and SFG Investment Advisors. Good evening, Chuck.
Good evening, Paul. Good evening, Pat.
Welcome.
Great to see you.
Welcome.
Good to see you again. It's always good having you on the show.
Thank you.
I wanted to continue our discussion on performance awards. Can you tell me whether performance awards are something that are growing? Are more companies starting to make use of them?
Thank you very much. So the answer is yes. We're seeing an increasingly larger number of companies that are issuing various forms of performance awards. So for instance, one of the major accounting firms recently did a study and found that 74% of public companies now have performance awards. That's a huge increase. And more specifically, when a company designs an executive stock-based incentive plan, those plans tend to be rather broad in scope. And what the accounting firm found was that just in the last 3 years, the number of companies that include in their plans performance type awards has actually jumped by about 16%. And 87% of the plans actually have one form or another of performance awards. So there was a period of time where companies were only awarding based on various forms of time-based awards like stock options, whether they were non-qualified stock options or incentive stock options or other forms. So we are clearly seeing a trend towards performance awards.
Very similar to private companies.
Absolutely.
So could you give us some specific examples of the metrics involved and how they might play out over time?
Thank you. So we did talk in our last show about a number of different types of metrics. Earnings per share, could be total shareholder return, it could be return on capital, it could be return on equity, it could be operational efficiencies, it could be customer satisfaction. So those are various forms of metrics. Probably the most widely used are total shareholder return awards or metrics. So let's talk about what that means more specifically. So a total shareholder return might be a percentage, and it might be a percentage increase from a stock's current price up to a certain either a percentage increase relative to a company's peers, or a percentage increase relative to the company's stock itself. So there are absolute internal total shareholder return metrics, but there are also relative total shareholder return metrics. Is the stock price increasing by, let's say, 10% over the next 3 years? If so, then that metric is met and a performance award either is granted or it's vested.
Well, I could see where this would be pretty important to proxy advisory firms. Can you tell us why shareholder proxy advisors are most interested in companies that use performance awards? What's in it for them?
Yeah, so what would be important to a proxy advisor? Obviously, they are advocating on behalf of their shareholders. And the shareholders' interests are going to be, is a senior level named executive officer, a Section 14 or a Section 16 executive, being compensated at a higher level than, let's say, the vast majority of the employees? Is there something that's detracting from the shareholder price? Is there, so a proxy advisor is going to look at, are shareholder interests being aligned with in terms of how the executive is compensated or not, and advise when it comes time to voting, advise those shareholder groups accordingly. The proxy advisors have gained a lot of influence in terms of how corporations conduct their affairs.
So when we look at these metrics, are these metrics focused on sort of a 1-year time horizon, a 3-year time horizon, a 5-year time horizon? Because as you extend your horizon, the actions to optimize what you do over time for the executive differ. So if what I'm trying to do is optimize the company's performance over a 5-year period, that might be a very different set of actions I might take. In fact, I might do maybe some major investment today that's going to pay off over the next 3 years, versus if my performance award is for the next year or two, I might avoid that same major investment because I want to hit certain metrics over the next year or two. So all of a sudden you have this tension between short-term and long-term. How does that play into the specific metrics for the company, and how does that play into what the proxy advisors are advising the shareholders?
That's a great point, Paul, and you're absolutely right. Obviously, shareholders most often are looking to the next quarter's earnings report and whether the company is going to be consistent in terms of paying a dividend that they'd always paid, or will it be adjusted down or go sideways. So certainly, quarter by quarter, there tends to be a short-term focus. One thing that is very attractive about performance awards is it does extend the view to a longer term period of time, so that a CEO is afforded more time to carry out certain actions that will benefit the company and then be rewarded further down the road. So, so I think maybe the follow-on to your question has to do with, well, how would those metrics be met, right? So, so a grant might be made, let's say, this year, and the grant then has the potential of vesting over the next 3 years. And that vesting might occur when, for instance, the stock price increases 10% per year each year. And then once that is met, then that vesting occurs. Now, more specifically, a senior level executive might be able to exceed a target. So they might have a target of performing at 10%, driving the stock price higher, but if the stock price goes up by, let's say, 12%, the award might pay or vest an additional 20% just due to the fact that the stock price has been driven higher. But companies are very carefully crafting these to make sure that the awards don't vest unless those very strict standards are met, those very strict metrics are met.
Well, I can see where this could be a real plus for the shareholders, because they too want to see the company stock advance in price, and they would want to see the executives compensated only if that happens. But are there any cons for the shareholder with a company that does use performance metrics?
So what happens, we're talking about a very simple form, how a performance is expected to vest. But what if those metrics aren't met because there are maybe extraneous factors? Maybe there are currency differentials that prevent the numbers from being met, or something that affects some unknown factor that wasn't in the line of sight of the CEO or the CFO. So it could be that a performance award actually acts as a disincentive if those metrics are not met. So that's one example. Another example is the complexity of these. So vesting might accelerate given certain metrics being met, but it's a lot easier for a senior executive to know what he or she is going to have if, let's say, the granted options, they do their time, excuse me, and the vesting occurs after 3 years, whereas with the performance awards, there is far more complexity to them. And so it could be a disincentive. Look, we want to get top performers driving performance, right? So if a performance award actually works contrary to its objective, then you've spent a lot of money as a company, and you've paid a lot in administrative costs, accounting costs to try to manage this. And if those metrics aren't met, that's an expense obviously to the shareholders.
So, because the other thing I'm thinking about, all these performance metrics, you can have things happen overseas. And the other thing with the performance metrics too, I don't think too many companies in 2007 were planning for the 2008-2009 recession. So if I, as an executive, got all these performance units, and then we had the 2008-2009 recession, and my stock wouldn't even recover to where it was maybe until 2012 or 2013, and I might have done a great job during the recession, so my company's profits, instead of going down 40%, went down 20%, but my stock price still went down, 30, 40%. So you can have instances where executives do fabulous jobs, but the performance metrics in that performance package have nothing to do. And then I guess what happens, do companies reset and recognize the value the executives have provided to the companies?
There is a tendency not to reset, but that can be done. Why? Shareholders, what's their chief concern? It's dilution to their earnings. Mm-hmm. So if there's a reset, what does that do to the number of shares
It increases the number of shares.
It increases the number of shares, and that's going to be a driver for the shareholders. They're going to pay a lot of attention to that. Absolutely.
So then, given all of that, what do you see as future trends for performance awards?
So I think performance awards are here to stay. I think they're only going to grow. But I do think that companies are going to need to make sure that the executive does not operate with such a high degree of uncertainty around their personal future. So as a financial planner, for instance, if I'm meeting with an executive, that executive is going to want to know, can I deliver a strong leadership to this company and then retire out comfortably or leave the company with a solid legacy? And so the impact to the executive personally will drive an impact to the shareholders. So the point that I'm making is that there is going to continue to be a need for various forms of retention awards. Mm-hmm. Options will continue to be issued. Stock bonuses will continue to be issued. Employee stock purchase plans will continue to be issued, so that there is a solid foundation to an individual executive's future. But then, in addition to that, will be this need for performance awards, and comp committee, consultants are really trying to figure these out because they are still relatively new and more visible in the more recent years. To shareholders, there's a lot more being written about them. There's a lot more being publicized about performance awards.
So if we were to think about all these performance awards and sort of where we are, where things are trending, what are some of the sort of metrics out there in the future that we could expect to get added to these performance awards over time?
Okay, so I think that there's a lot more being done in the way of analytics. Let's just talk about an absolute total shareholder return specifically. And as I mentioned a few minutes ago, the absolute total shareholder return metric, a company's stock performance might have to go up by a certain amount. Well, what we're going to begin to see is not just targets and not just the ability for an executive to achieve above those targets and be rewarded, but there may be some acceleration tied in. So again, if the stock price increases by 15%, and there was thought to be an upper limit of, let's say, a 12% increase and a target of a 10% increase, there's going to be more design around rewarding the executive when that 15% increase is actually met. So, a lot of the great compensation firms that are out there have very elaborate IT programs that will run these various simulations and iterations to calculate how rewards will be compensated based on accelerated metrics being met. It really is a fascinating trend, and I think it's one that we'll continue to see.
Well, let's look at this from the shareholder's point of view, or the potential shareholder's point of view. What would be important for them to know about performance awards in maybe anticipating buying such a company or buying shares in such a company?
Well, if you have a strong leader, don't you want to reward them well?
Yes.
If you've got a CEO that's a visionary, there's certainly a lot of big names that have done very well for corporate America. The shareholder is going to want that senior leader to remain in place and to continue to excel in their role, because that's beneficial to the share price. And that brings about certainly, financial security for the shareholder. So I think that a new shareholder is going to want to ask the question, the company that I'm looking at, does it have a performance award? If so, what type of performance award? That is a consideration. We are seeing trends towards CEO turnover. Well, what better way to retain top talent than to make sure that there is a performance award? So the shareholders are going to need to do their homework, and they're going to need to look into the proxy statements, and they're going to need to look on the SEC's website and understand, how are these senior level executives being rewarded?
Yeah, I know that when we do analysis, one part of our analysis is how is the senior management being compensated, because it's important to think about how they align what they do with how they're compensated, and then how that plays out into impacting not only the company but the share price.
Right.
It's all part of ensuring that there's this alignment.
Yep.
So if we were to think of a couple of things for, the viewers should just keep in mind. So if there were, let's say, 3 important things to focus on going forward with these trends, what would you say they would be if we're looking in this whole area of performance awards that our viewers should keep in mind?
Okay, so are there single metrics that a company awards or ties their awards to? Are there multiple metrics? What are those metrics? Earnings per share growth, return on capital, combination of both. Would it be total shareholder return? Maybe a combination of total shareholder return to, let's say, operational efficiency. So the 3 things that a shareholder will need to consider: 1, does the company issue performance awards? Number 2, what type of awards? And number 3, are there single metrics or are there multiple metrics?
That's very good advice for the viewers. And if you were a corporate executive, what advice would you give him?
I would say get with an advisor that understands the complexities. You are compensated to keep your focus and to drive the company's performance. You most likely have very little time to be able to manage all of your affairs. There are a lot of moving parts, especially if you've been a senior leader with the company for a long time. There may be dividend reinvestment shares that you've accumulated over a period of time, and how do those shares interplay with with your other forms of compensation? Also, if you are an insider, you have an added layer of complexity that needs to be addressed.
Unfortunately, we could go on for very long, but we have run out of time. Our guest next week is Frank Miranda. Frank is CEO of EAC Valuations, and they specialize in business valuations. And from all of us here at Money Matters TV, your money matters.